Part 2, Accounting for Legal Reorganizations. This particular chapter focuses on Chapter 11 bankruptcy, which includes the option of fresh start accounting. The legal way to salvage a company rather than liquidate, the company is temporarily protected from its creditors. Creditors are encouraged to negotiate new terms with the company. Control of the company is normally maintained by the owners. Creditors may take over as new owners. Workers keep their jobs, suppliers keep their customers maintain their source of supply. Accounting for a company as it moves through reorganization. Gains, losses, revenues, and expenses of the known reorganization are reported separately from normal operations on the income statement as part of other. Gains and losses on sale of assets if sale is a direct result of the bankruptcy and significant professional fees. Costs are recorded as expense when incurred regardless of the monetary amount. So these are the type of things you'd separate out. Assets are still reported at book value. Current versus non-current classifications are not applicable for liabilities subject to reduction by the court's acceptance of the plan. So everything would be shown for liabilities as current. These liabilities should be reported separately of the amount of the claims. Liabilities not subject to reduction are all shown as current versus non-current. Fresh start accounting, this is something that when they reorganize they'd like to have, and the reorganization or market value of the assets are less than the total of the allowed claims as of the date of order for relief plus any subsequent liabilities. The original owners are left with less than 50% of the voting. So those are the requirements. Fresh start accounting is one method where you can actually report goodwill. Assets are restated to individual current value. Liabilities except deferred income taxes are stated at the present value of the future cash payments. Normally, additional paid-in capital is adjusted to balance. Retained earnings must be taken to zero. So here is our example. We have Danny Company. The reorganization value is $800,000. Danny has 50,000 shares of outstanding stock with a $10 par. There's a deficit in retained earnings of $670, and Danny will redistribute 30,000 shares of this stock as part of the reorganization. First, we have an accounts payable that's going to be settled for an 8% 2-year note for $35,000. Accounts payable of $97,000 would be paid in full, so we don't have to do anything about that. Notes payable of $200,000 will be settled for 8% 5-year note of $50,000 and 15,000 shares of stock. And last, we have a notes payable of $350,000 will be settled for a 7% 8-year $100,000 note plus 15,000 shares of stock. Now, we also have listed the assets where we have book value and fair value. Now, do we meet the requirements of fresh start accounting? Yes, because the total value of the claims is greater than the reorganization value, and the original owners are giving up more than 50% of their voting stock. They're actually giving up 60%. We can do fresh start accounting. Now, the first thing we need to do is see, is there any goodwill? So what we're going to do is we're going to add up the fair value of the assets and subtract them from the reorganization value. And in this case, we get $147,000. Right here, we get $147,000 of goodwill. Also, we're going to have to write down our assets, except for landing building, we have to write up. Next, what we're going to do is determine the additional paid-in capital. Now, it is zero under the book value method, but we end up with $18,000 under the fair value method. So what you want to do is you want to add up your total assets, and of course, under the fair value method, it has to equal the $800,000, which is the reorganization value. We're going to subtract our liabilities, subtract our common stock. We know that retained earnings goes to zero, and assets must equal liabilities plus equity. So the plug in after the reorganization is going to be the $18,000. So that's how we come up with the implied additional paid-in capital. And now we can determine additional paid-in capital per share by taking the 18,000 and divided by the total number of shares outstanding. And that means every time we exchange a note for shares of stock, we also have to book 36 cents per share for additional paid-in capital. All right, the first thing we want to do is we want to write down or adjust our assets to fair market value, and the difference is going to go to additional paid-in capital. Next, what we're going to do is we're going to journalize our common stock being returned to the company, and we're going to debit common stock based on par, and we're going to credit additional paid-in capital. Next, we're going to journalize the liability. Now, here's the thing to remember. What we have to do is we have to take the old liability off the books and put the new liability on the books. So in this case, we had accounts payable of 180, and we were able to get a note, 2-year note at 8% for 35,000, and then the difference is going to go to gain on debt discharge. The next item, we had a notes payable of 200,000. We exchanged that for a 50,000 5-year note at 8%, and we also gave them common stock. We gave them 15,000, $10 par, or debits equal to credit, so there's no additional paid-in capital. Next, we had a notes payable of 350,000. We settled that for 100,000, 8 years, 7% notes payable. 15,000 times $10 a share was the par. The additional paid-in capital is 36 cents times the 15,000 shares, and then we plug the gain on debt discharge for 94,600. And then the last thing we want to do is zero out the deficit and the gain on debt discharge and take it to additional paid-in capital. Now, to see this, you needed to keep the accounts. So this is what it would look like. There's our write-down of our assets. There's a return of the stock. And there's the additional paid-in capital and excess of par. These are all adjustments to additional paid-in capital. And then we would have closed them out. We would have zeroed out our gain on debt. That's how we get the 239,600. We know that the deficit is 607. That has to be taken to zero. So the difference is going to go to additional paid-in capital, which agrees with our 18,000, which is what the balance should be. Now we can do our balance sheet based on all of our new values. There's all our liabilities. And as you can see, our assets equal our liabilities plus equity. So this is what you would do when you have fresh start accounting. The main thing to remember is coming up with that new, if there is any, that new additional paid-in capital amount. And the other thing is figuring out the goodwill and then making sure you take the old debt off the books. That concludes this presentation on reorganization, or Chapter 11, when you do fresh start accounting.